Today, we are going to talk about common mistakes we see and hear when it comes to whole life insurance when one has an objective of maximizing the cash value. So, point number one, not enough cash value up front. My premium's too high. So what I should always look for when I am looking at a high cash value life insurance policy and I'm interested in the cash value because it is a safe, liquid, tax-free area to position money, here's exactly what to look for. If I pay $1 in, I should see 85 to 95% of that dollar in cash value immediately, right up front. I should be breaking even between years 3 and 5. Now, there are occasions where I might break even a little bit later. The cash might be a little bit less upfront if it's a different type of product. If I have health issues, there are factors that can adjust that, but for the most part, I should see that value up front. And what's so interesting is often we hear about, let me know if you've ever heard about this, about banks, corporations, the elite and ultra wealthy using high cash value life insurance. And they do it for the cash value. But then you see a policy and you're like, why would a bank or corporation put money here? Because you're shown something where you're told to put money in and you see 60 or 70% or zero in cash value in the first year. So many people see that. I remember talking to a couple. They do extremely well. They're doing about 85 million per year in revenue. This couple is younger than me. And they were pitched on whole life insurance before. And I remember the wife said, well, fortunately, my husband can do math, and looked at the numbers and said, there's no way we're doing this. They were shown a policy that took something like 7 to 10 years. I think it was 10 years to break even, long time to capitalize. Didn't make any sense. And the main thing they mentioned was, listen, like whatever the long-term returns are, that's great, but it's the opportunity costs. They're business owners. This is a great area they can store cash that's presently just sitting there in their bank account. Now they can put it here, actually have it go to work for them. They've got a tremendous tax benefit, and they can access it to use as a personal line of credit for their business and such. They looked at a policy. They actually opened one with high cash value right off the bat that serves what they need and want to do. Oh, and they have the long-term performance as well. This is what people with money do, and anyone can do it. You don't have to have millions of dollars to achieve this. Point number two, company selection and PUA flexibility. So if you've watched any of our videos, you've probably heard the words Big Four or major mutual companies come out of my mouth, I don't know, 10,000 times. When it comes to cash value life insurance, we've seen these companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, consistently deliver the highest and strongest cash values to policyholders. And I'm talking about actual performance, not illustrations, not just a projection I see on paper, because I can easily take some other companies and say, hey, I bet you I can provide way stronger values by using a different company. The thing is, with illustrations, yeah, I like them. I'm a nerd when it comes to designing policies. I always have been, I always will be. But at the same time, I like the actual data, because the whole illustration game, when I see illustrations that look great, I can show you these beautiful values long term. If they don't come true, you're going to be disappointed with the company, but more so, you're going to be disappointed with me. This is why I'm so big on these companies. We've seen them consistently deliver. Now, in terms of PUA flexibility, that's really what helps one refine their decision-making process. Quick example, if I take those 4 major mutual companies, Guardian is a company that allows me to commit to a minimal premium, and then at my discretion, I can just add money into PUAs on an unscheduled basis. I can go on my online account, my mobile app, send in a check, just dump money in without any underwriting if the policy is set up properly. Very flexible. Mass Mutual has some similar flexibility. Where you can really make a Mass Mutual policy hum is if I want to pay in a high dollar amount for a long period of time, and I can make PUA adjustments 1 time per year on my anniversary date without any underwriting. 2 quick tips there. Good stuff to be aware when it comes to refining my decision-making process. If I don't want to get a bill 1 time per year, I want to add money to it, just like dumping funds in, That's where Guardian could be a good option. Mass actually has similar options to that, but the awareness is key here. Point number 3, non-direct and direct recognition. Lots and lots of buzz around this, and there always will be. It's a fun topic to talk about. My personal opinion is if you are considering a policy with one of the major mutual companies, it does not matter. A myth out there is that direct recognition companies will always reduce your dividend when you take out loans. That is simply not true. Direct recognition means that the company will recognize the fact that you take out a policy loan and adjust your dividend rate on borrowed funds. Non-direct recognition means that they will not recognize the fact that you take out a loan and will not adjust your dividend. So, for example, if we look at non-direct, here's exactly how they work. If I have a non-direct recognition company, can use Mass or New York Life. Let's use Mass. They've got a clean 6% dividend, and their variable loan rate is 5%. If you have cash value of $100,000 and you take out a loan of $50,000, what's going to happen here? Well, you'll have $50,000 remaining, call it an equity or remaining cash value, but here's what will happen. Non-direct recognition means that the company does not recognize the fact that you take out a loan, and they continue to pay the same 6% dividend on your entire cash value. So you have a 5% cost to borrow on the $50K. However, that 6% dividend is applied still to the full $100,000. Another way I like to explain it is I get the same 6% dividend here, and I still get it here. Even though I pulled money out, I continue to receive that dividend on my entire pot of cash, which is great. And really the main way the company does that is by collateralizing my death benefit. If I pull out $50K, I'm going to see my death benefit drop by $50K. Now, where that differs from direct recognition is as follows. Let's assume I've got a policy, let's not use Mass, let's use Guardian here, we mentioned them earlier. They have a 5.65% loan dividend rate and a loan rate of 6%. A lot of times people see that and think, oh, that's a negative spread on paper. And it is a negative spread on paper. I have Guardian policies myself. Here's the thing, direct recognition means what? They recognize the fact that you take out a loan, and they adjust the dividend on borrowed funds. Here's what they do. If I take out a policy loan, I am still going to earn dividends on the full $100,000. Here's the difference though. Any money still in cash value receives the basic dividend rate. And here's exactly what Guardian does. They still pay a dividend on the loan portion of $50K, but they raise it to 6% in order to match the fixed loan rate. This way, a policyholder does not feel like they're going to be punished for borrowing from their policy. Northwestern Mutual has a similar practice with their direct recognition loans. Mass Mutual has a similar practice with their direct recognition loans. You can elect a direct recognition policy if you pick their fixed loan rate when starting a policy. The point here is when we look at the actual performance, if I'm heavily borrowing with the major mutual companies that have a tendency to raise dividend rates right now on borrowed funds, and they've done that for a very long time, that's where I'm in a position where I look at it and say, hey, it don't matter. Really, when I look at it, I mean, it's extremely interesting, but it doesn't matter. We've seen the actual performance almost wash out every single time. Point number 4. Guaranteed and dividend values. So this one's very important to be aware of. When I look at the guaranteed rate on whole life insurance policies, the guaranteed rate since the 1980s has been at 4%. The guaranteed rate on all policies issued from the 1980s through the majority of 2021 will still be 4%. The guaranteed rate from 2022 onward will range from 2 to 3.75%. And this is a direct result of the 7702 rule that was passed. And it depends on the company and their products. For example, if I take Guardian, New York Life, and I believe it was Northwestern as well, but don't quote me on them, they all filed the guaranteed rates for their products at 3%. So that's what their guaranteed rates will be moving forward. They're going to be releasing those products in the very near future. They might even be out by the time this video is released. MassMutual did it a bit differently, depends on their products. So like their 10-pay policy, for example, has a guaranteed rate of 2%. Their L100 has a guaranteed rate of 3.75%. If I take the middle, like a L20 or L65, I might see a 3% or 3.25%. Point is, they've got different guaranteed rates that apply to the products in different ways. So that's where we want to analyze it and see the actual guaranteed rates and guaranteed values on a policy. Same thing with the total dividend rate. Now, that's some supplementary information in there. I always like to do that. But here's really what I want to go over. Guaranteed and dividends. If I have a guaranteed rate, let's say it's a 4%, really doesn't matter. And then I see a dividend of 6%, if I take MassMutual, for example. What that means is the company declared a surplus of 2%, and then I've got a total dividend rate of, guess what, 6%. So, a couple things I want to mention here. First is an interesting or quick fun fact. Whenever you look at a life insurance illustration and you see that column that reads annual dividend column, it never reflects the insurance company's dividend rate. You think it would because they've got the word dividend there, but it does not. They like to make things confusing. I'm kidding. It's for compliance reasons. But anytime I see a dividend column on a life insurance illustration, it reflects the surplus only. But that's not super important for this video. Here's really what I want to touch on. All of these are a gross rate. Have you ever thought that I should go with any insurance company, say it's MassMutual, because they're paying a 6% dividend? I'm going to earn 6% on my money. So if I have $100,000, earning 6%, that should give me what? $6,000 in interest this year with no market risk? Like, that's a win-win. Sign me up. I don't get that in my bank account. I don't even get 0.6%. Doesn't work like that. I wish it did, but it does not. So here's what we got. That dividend rate is a gross rate that is always credited after the company's insurance expenses. So what I want to look for, and if you're a consumer or an agent, make sure you're always showing this. If someone's interested in the cash value component and thinking, hey, what did I earn last year? That question comes up. People view this as a place to put their money. It's their money you're dealing with. You must be transparent. So here we go. Internal rate of return. Here's a policy on a 40-year-old male, funding it for a short period of time. So if you've ever thought, I have to pay into policies for a long period of time, don't have to by any means. But what do we see here? We see $100,000 per year go in for 5 years. Guaranteed values. This assumes a 4% guarantee. Gross. It is always a gross rate. I like to emphasize that. First year, remember we mentioned that 85 to 95%? So based on the guarantees, you're just about at 89%. What is highlighted in yellow represents your break even. Just about year 5, and this is based on the guarantees. It's always done better than this. But here's really what I want to touch on. Annual internal rate of return. Does it ever hit 4%? Tops out right around that 3.3%. Annually, the average is going to be around 2.25, 2.5 in this example. So that 3.3%, that is the net cash value growth rate after the company's insurance expenses, mortality charges, everything they include there, based on the guarantees. If I look at the dividends, here we go. Same policy, just based on the company's present dividend rate. And what do we see? 100K per year going in, breaking even now year 4, annual IRR tops out at about 4.14%. The dividend rate on this example, is 5.65%. So after the company's insurance expenses, all that jazz, I'm at about 4.14%. Kind of see what I'm trying to demonstrate here is I see a crediting rate from an insurance company, and common sense would tell me if I put my money in this, I should receive that crediting rate. The reality is that that's not the case. So before I put my money into one of these products, I want transparency on that. And I don't always want to have to calculate this stuff. Like the agent should do it for me. Like we show this to everyone we work with. And then here's an indexed feature. So you can actually index whole life insurance where we can tie it to the S&P 500 for some additional earning potential. But the same thing, the indexed crediting rate is about 6% in this assumption. Doesn't ever hit 6%. So the main point of emphasis here is what? Anytime I see a guaranteed rate, a dividend rate, whatever it might be, remember that that is a gross rate that is credited after the company's insurance expenses. I want transparency there. That shows me my actual earnings rate. And that's very important too. If I've got a 6% dividend and I'm thinking I'm borrowing at 5%, so I've got a 1% spread. If my net return's 4% and I'm borrowing at 5%, it's a little bit different, isn't it? Yeah, it's a negative 1% spread. Which leads in to the last part I want to mention today, loan interest. All right. Loan interest, here it goes. So when it comes to policy loans, some things that are good to be aware of. Firstly, when I have loan interest, it accrues at annual simple interest, and it compounds if it is not paid. So if you have a calculator, this will help. That'll help. If you take a $10,000 loan at 5%, what's that come out to? You don't need a calculator for that. $500. Now, how loan interest actually works with a life insurance policy is whatever that annualized interest is, you would actually divide it by 365 days. And that would come out, what is it, $1.34 per day? Something like that. That would be the actual loan interest that would accrue each day, but it's simple interest. What I mean when I say but at simple interest is the $1.34 is not added to my balance, and then interest begins to compound on top of my balance plus the $1.34. No, it's simple interest for the course of a year. However, if I do not pay the loan interest, what happens here? It compounds. The policy, the cash value, borrows from itself to then cover the actual loan interest cost. My death benefit reduces by that amount. In this case, I would have $10,500 then as my loan balance the next year if I didn't pay that. And then interest would begin to compound on that. We'll accrue simple interest over the course of the year. If I don't pay it, it will compound over time. So it's good to be aware of that so we don't ever run into an issue where we think, wait a minute, I thought it was simple interest all the time and I'm earning compound. No. Loan interest paid to the insurance company, not paid back to ourselves. And typically the interest rate falls between 5 and 6%. Now, with the 7702 change, some companies will have lower loan rates. For example, we mentioned earlier that the Mass Mutual 10-pay product, do you remember what their rate will be? The guaranteed rate? So the guarantee will be 2%. If you had a 5% loan rate, even if the company pays a 6% dividend, but if you had a 5% loan rate, what's your comfort level there? Dividends go down, it can go all the way down to 2%. So MassMutual realized that. So what they did, it's a variable loan rate with a current rate and floor of 3%. So that's a bit different than most whole life products we see, where they kick it down to 3%. So again, awareness here is key. The more I can be aware of the stuff, the better I can do. Let's look at an example in respect to loan interest, and then we will wrap up with this actually. So this will be fun, depending on one's definition of fun. Look at all these spreadsheets. I gotta simplify this stuff. I'm working on that. And someone actually recommended that to me. I wonder if he sees this. If you are watching this, shoot me a text about drawing cartoons. But anyway, here we go. So what we did here is an example with $500,000 per year. This was someone considering a policy. He wanted to use it for a real estate purchase. So these are actual numbers he was looking at. $500K per year, total of $2.5 million. Here's the loans coming out, total of $2 million. Loan balance, loan interest, 5.66%. Each year, here's the loan interest cost. He's paying it out of pocket each year. He pays the loan back pretty quickly, $500,000 per year after he's done funding. All right, all these charts. Sorry, here's what I want to look at. Net interest payments. This is going to tally up his total out-of-pocket payments toward the loan interest over time. So if we look at this, what do we see? At that 5.66% rate, he has paid a total of $452,000, almost $453,000 in interest that went to the insurance company. Good to be aware of the exact dollar amount and the percentage, but the dollar amount that I pay to the company. Okay, now, what I have on the right, to the right of that, is a cash value collateral loan. We've got a lot of content on this, so I'm not going to go into the details. We leverage a policy with a bank or lender. The rate here is 3%. At this size, actually, we would get 3.25% here. We would get 3%, no problem. Let's adjust that. Beautiful. So same thing here. Got the 3%. Oops. 3% interest rate. Here's my interest payment each year. Annual interest. Actually, let's cut that out. Sorry. So we've got the interest rate adjusted to 3%. Interest rate, 3%. You'll definitely get that instead of 3.25%. Here's his out-of-pocket interest payments each year. Same $500,000 loan for 4 years, total of $2 million. He's leveraging this policy, just assigning the cash value to a bank in order to obtain a more attractive interest rate. And look at this, net interest payments, $240,000 instead of $452,000. That is a tremendous savings right there. Definitely worth being aware of that. Now, some people don't like these loans. Some people do, but if I'm aware of it, I can select it if I'm comfortable with it. And again, we've got more videos that provide more information on this. I like them, especially right now in the low interest rate environment. So hopefully this helped. If you enjoyed this video, please click the like button, subscribe, and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.